when they sit around on the committee and they continue the conversation today, if it does indeed to continue, and they ask themselves, what's the biggest risk here? Upside risk to inflation or downside risk to growth? What else do you think they come up with?
I think that they would look at the dual mandate. And it is absolutely correct that inflation was 9.1 in the summer of 2022, and now it's 2.5. So we've come a long, long way when it comes to inflation. But the other side is the dual mandate, namely full employment. Yes, the unemployment rate has gone up a bit, but literally all other economic activity indicators, real indicators for everything across GDP, as you saw yesterday, industrial production, retail sales, remain quite strong. So now you begin to sit and look at the real side of the economy and say, should I put a lot of weight on the unemployment rate going up a bit largely because of labor supply, or should I put more weight on all the other real economy indicators are actually still in relatively good shape? So I think that they would do it from the perspective of saying, what's the dual mandate saying, and where are we on the various indicators on the side of the dual mandate?
So do you take issue today with the decision of reducing interest rates, or take issue with the conversation about them returning back to 3%? Quickly.
So I do think that it is the returning back to 3% that's problematic, because the 3% number, the R-star number, or the terminal estimate that they have put out in the dot plot that they now literally have on the New York Fed homepage, that R-star where we're going is 3%. That turns out to be wrong, because if this were the case, monetary policy would be much more restrictive. And the incoming data, when you look at it, Atlanta Fed GDP now at 3% yesterday, that's not restrictive. If you look at what happened to industrial production yesterday, that's not restrictive either. If you look across the board on a wide range of indicators, it doesn't look like monetary policy is particularly restrictive. Most importantly, in credit and in private credit, you're seeing that loan default rates are going down. If we had a recession, default rates would not be going down, they would be going up. Even if we had a slowdown, it would be the same. So given this vast majority of indicators, when you look out of the window, still telling you that things are actually still okay, then it is problematic to sit there with high conviction and saying that monetary policy is very restrictive.